Hello guys, good evening. Uh, this is Saeed, your lecturer, and this is Futures and Options or lecture on options. Okay, um, I'm not sure whether you are watching this video. Can you please write in the chat box whether you can hear me clearly? I had a problem with the mic, but I assume the problem has been sorted out. So if you can hear, okay. If you, Oiro, can you hear me? All perfect. Okay, well, okay, very good. So let's go to the first topic. Today's topic is on options. So far, whatever we have discussed were about futures, and now, from now onwards, we want to discuss about options. So for today's topic, I will start with an introduction on options. Then I will show you some strategies. For today's topic, you need to pay attention. I will use some terms that you already have heard, but today I want to mix them. And if you don't pay attention, then later you may find it a bit difficult to follow. I mean, at least today's lecture, in the first half an hour, you need to pay attention, and after that, again, you need to pay attention. But if you don't get the concepts that I introduced to you in the first half an hour, then it will be difficult in the second part of the lecture to follow. So let's start. I want to share the slides with you. So let's go to, oh guys, give me 1 second. Let me close the, there are a million files here. Oh my God. Even I see the, okay. Let's see. Yeah, I close all files that we didn't need. Now let's share my desktop with you. So as I said, first I will introduce a few simple basic concepts on options. Then I want to show you some complicated strategies which you may find them interesting. Okay, so let me tell you what we mean by options. Okay, so it's better to use the handout. Options is like it's a contract, right? So for each contract there are two sides, two parties. Let me fix this. Yep. So there are two parties for options. Two parties. Yep. One, start from here. Isn't it too small? Is it too small? So one is the seller of the option, or writer of the option, or issuer of the option. Any name you prefer, you use. So there is a person who prepares this contract. There's a person who sells this contract. There's a person who writes this contract, and we call it the seller, right? And the seller prepares the contract and then sells in the market to so there is a contract which is called options. Too small. Options, and this contract will be sold to the buyer. So he is the buyer of the contract, right? Okay. Now, what is this contract about? So the buyer of the contract will pay some money to the seller of the contract to receive the contract. So the seller will sell a contract to the buyer, and buyer in return should pay something, right? This is called premium. So the buyer will pay a premium to the seller to buy this contract. Now this contract is called options. And how it works? Options give right to the buyer of the contract to exercise the contract or not. So it's not an obligation. For futures contract, when you go short or long, it's an obligation for you, right? But for options, they are more flexible. For options, the buyer of the contract has right to exercise the contract or just leave the contract. And if the buyer decides to exercise the contract, then this is an obligation for the seller to exercise, to follow the contract terms, right? So this is the main difference between futures and options. So for options, it's a buyer's right because he paid the premium. So he has right to use this contract or not, to exercise the contract or not. But for the seller, if the buyer decides to exercise, the seller must follow it, must follow the contract, must complete the transaction. Now, for options, we have, let's see if I have another color. For options, we have two types. So we have call. So we have two types. We have call and we have put. So options have two types, call and put. What is call? Call gives right to the buyer of the contract to buy an underlying asset at the strike price during a period. For example, the lifetime of the option contract can be maybe 1 month, 2 months, 3 months, right? So if it's, let's say it's 3-month contract, this 3-month option, this means that if it's call, then the buyer has right to exercise the contract at a specified price during the next 3 months. What does it mean? This means, so the call means call. So for call, let me use another color. Which color do you like? Call means buyer has a right to what? To buy. So for call, buyer has right to buy. To buy what? The underlying asset at a specified price in the let's say next 3 months, right? At the strike price in the next 3 months, right? Now, what if it's a put? If it's a put, then again buyer has right to sell the underlying asset at the strike price, blah blah blah. So the difference between call and put is, from the buyer's perspective, for call, the buyer has right to buy the underlying asset at the strike price or exercise price, but for put, the buyer has right to sell the to sell the underlying asset, which can be anything. Let's say stocks, Apple stocks. So at the strike price. This means, okay, let me give you an example. Suppose that we are talking about Apple stocks, right? For Apple stocks, if you believe that the price will go up, you may buy a call, right? So buying a call means, you suppose that today Apple stock is traded at 50 ringgit per share. Assume that Apple stock today is traded at 50 ringgit per share. And if you buy call, this means you have the right to buy Apple stock at 50 ringgit per share if the strike price or exercise price is 50 ringgit per share during the next 3 months. So in the future, in the next 3 months, let's say next month or 3 months later, if Apple stock price goes up to 60 ringgit, based on this contract, you still can buy that 50 ringgit per share. So when you predict the price, when you are bullish, when you believe the price will go up, you may buy call, because you lock in the price, right? So even if the price goes up, you still can buy it at the 50 ringgit per share if the strike price or exercise price is 50 ringgit. But for put, when you buy put, this means you have the right to sell the underlying asset at 50 ringgit per share, let's say if the exercise price is 50 ringgit, right, in the next 3 months. So 3 months later, if the price of the stock goes down to 40 ringgit, you still can sell, because you buy put, you still can sell the stock at 50 ringgit per share. And it's good, because in the market the price is 40, the price dropped to 40, but you still can sell it at 50. So it's a good news. And if you exercise the contract, then the seller needs to complete it. For example, in my example on Apple stock, if you buy call and then the next month the price goes up to 60, so you still can buy, based on the contract, you exercise the contract, you still can buy the stock at 50 ringgit per share. So you buy at 50 ringgit per share from the seller and then sell it in the market at 60 ringgit, right? So it means you make 10 ringgit profit. But of course, you need to deduct the premium, because you paid something in advance to buy this contract. So it's the 10 ringgit profit minus the premium is your net profit. What about the seller? For the seller, in this case, is a loss, right? Because the market price the market price is 60, but he has to sell it to you at 50 because you bought a call. So it's a loss for seller. How much loss? 10 ringgit minus the premium he received initially. And what about for put? For put, it's the opposite. You buy a put if later the price from 50 dropped to 40. This means you still can sell it at 50 using the contract, because the contract allows you to sell it at 50. But suppose the price of the Apple stock dropped to 40 next 3 months later. So what you do? you have the right to sell it at 50, right? So you sell it to the seller at still 50 ringgit, but the market price is 40. So you buy from the market at 40, sell it to the seller at 50. You make $10 profit minus the premium, right? And of course, it's a loss for the seller. But what's the problem? When the seller can make profit? When you don't exercise the contract, the seller can make profit. How? Suppose you buy a call and then the price, so when you buy the call, you expect the price of the stock of the underlying asset, which is stock here, goes up, right? Suppose you buy call, and in my example on Apple stock, the price goes down. This means now the price in the market is 40 ringgit. So based on this contract, you still can buy it at 50 ringgit, but in the market the price is 40. Will you use the contract? Will you exercise the contract? No. Because based on the contract, you have to buy something at 50, but the current price is 40. Why should I follow? Why should I use this contract? I won't exercise the contract. And this is the advantage of options. They allow you, you have the right to exercise the contract as the buyer. So you don't exercise the contract, and what happens? The seller will take your premium. So this premium that he already received is his profit. So the maximum profit for the seller is limited to the premium that he receives. But his loss is unlimited, right? Because the price can move in the prediction in the direction that you predicted, and he may have unlimited loss. The seller can have unlimited loss. But for buyer, the profit can be unlimited because, for example, if you buy a call, the price of the Apple stock may go up every day. So your profit is unlimited, but your loss is limited to the premium that you paid initially. This means that for buyer, you are taking less risk in terms of the amount of loss. It's limited to the premium. But for the seller, the loss unlimited, can be unlimited. And yep, so this was an introduction on options. I'm sure you already have you have read about, or you have studied options in your previous subjects, but I think it was necessary to have an introduction. So yeah, let me share again the slides with you. Okay, so far there is no comment. Okay, let's continue. Okay, before I continue, guys, in the previous tutorial class, the last week tutorial class, I asked you to watch the videos I have prepared for the lecture on futures contracts. And yep, these are the videos that I prepared. Financial futures topic, right? Financial futures. You need to watch them, and before our next tutorial class, you need to, yeah, leave a comment here. I just want to make sure that you are watching, you're not missing this topic because it's the most complicated topic. So you need to write your name here, and some of you even have written your student ID, which is good. I just want to know who has watched this video. So you need to write 1 sentence, 2 sentences about the videos that I have posted to make sure that you have watched them. So watch those videos I prepared on financial futures before our next class. Okay, let's go back to our slides. So this is a summary of what I just discussed and I just explained. And There are two types of options, European and American. Americans are more flexible. This means that you can exercise them at any time during the till maturity of the contract. But for Europeans, you have to wait until the maturity. And yeah, this is again not new. What I discussed, I can cover this one as well, this slide as well. So for call options, you have profit when the spot price means the underlying asset price is greater than strike price. Strike price means the price that you agree to buy or sell till maturity, right? It's called also the exercise price. So for put when you buy call, this means that you expect the spot price to be greater than a strike price, and for when you buy put, you expect the spot price to be less than the strike price. Okay, so based on these buy and sell of call and put, you can have four strategies: long call, long put, short call, short put. So long call means buy call. Long put means long put means buy put. So these two are the long call, long put. They are based on the from the buyer's perspective. And for short call, short put, these are from the seller's perspective. So when you use long call, when you expect the price increases when you are bullish. What about long put? When you expect the market goes down, when you expect it bearish, the prices are going down. For short call, you expect the price won't change or will decline if you are selling call. When you are selling call, your profit can be maximum the premium you receive. And when will you receive? You will receive this premium, which is the maximum profit you can make, when the other party, means the buyer, is not exercising the contract. And this is the time for call that the price goes down or doesn't go up. Let's say it doesn't go up, right? And then the buyer won't exercise the contract and you collect a premium. For short put, when you believe when you expect the price won't go down. So when the price is not going down, it can be the same or it can increase. This means that you can you can collect a premium because the other party, who is the buyer, won't exercise the contract. Now, I want to show you. So this slide is very important. This is more important. We will be using these diagrams a lot. So what is this? And this shows a long call profit and loss, right? So in this example, we assume it's a European call option. Okay, option price is $5. Strike price is $100, and it's a 2-month contract. So now, so this is buy call. For buying call, you expect the price goes up, right? Buying call means from the buyer's perspective. You expect the price goes up. Now, see, if the price of the underlying asset, let's say Apple stock, in the market is $90, then based on this contract, okay, first of all, option price is a premium. So you pay $5 to buy this contract. Now, strike price means you can exercise the contract at $100, means you can buy the underlying asset at $100 during the next 2 months. So, but this is European, means at the end of 2 months. So, if the price of the underlying asset in the market is $90, the contract allows you, because it's a buy call, the contract allows you to buy the underlying asset at $100. Will you exercise the contract? So again, suppose that the market price of the underlying asset is $90. Based on this long call, you can buy the underlying asset at $100. Will you use this contract? No, because in the market the price of the underlying asset is $90. Why should I use this contract to buy it at $100? Why should I buy it at $100 when the market price is 90? So I won't exercise the contract. And if I don't exercise the contract, this means that the seller of the contract can collect just the premium, and that's all. So my loss is limited to the premium. So my loss will be $5. What if the and this is the same story when the price of the underlying asset is 70, 80, whatever. So still you can make, I mean, still your loss is limited to $5 per share. Because of course you won't exercise the contract. You won't buy it at $100 when the market price is $70, right? But if the price in the market goes above $100, then you should exercise the contract, right? Now, and for example, if the market price now is 120, so if the market price is 120, you still can buy it at $100. This means that you buy it from the seller at $100, then you sell in the market at 120, means you make $20. $20 minus $5 premium that you paid initially to buy this contract means $15 profit. So here we have $15 profit, right? This is profit against stock price. I forgot to tell you in the beginning. So profit against stock price. So this is long call. So what do you see from this? You see that the loss means any profit, negative profit, right? Anything below this line, below this line, right? So below this axis. So this means that your loss is the maximum loss for a buyer of the call is $5, which is the premium you pay. And what's the break-even point? The break-even point means the time that you don't have any profit or loss, and it's 105. How to compute 105? Very easy. You can compute, but anyway, the shortcut, the formula is strike price plus the premium. So 100 plus 5 is $105. It's the break-even point. You need to have a very good understanding of this. And here you can see your profit as the buyer of the contract is unlimited. It can go up, 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 right? Because the stock price, the underlying asset price may go up, up, up. So this is very important. You need to be very comfortable with this diagram because we will be using them. We will combine different types of diagrams and do some financial engineering. And what is the difference between long stock and long call? For long stock means you buy stock. For long stock, I mean, if you believe the price of stock will go up, you may buy the stock, right? But sometimes you want to limit your risk. In this case, you may buy call instead of buying stock. You buy call, you see your loss is limited to $5. But if you buy the stock, your loss can be huge. So this is the difference between why long stock is a bit is above this line, because when you buy call, your profit will be $5 less than the time that you buy stock. So they are moving like this, very similar, but for the loss part, long stock unlimited loss, but you can use long call if you believe the price will go up, but you don't want to take much risk. What about short call? Short call is the other side. So we just discussed long call. This is short call. So short call is from the seller's perspective. So from the seller's perspective, if the price of the underlying asset in the market, let's say, is 80 or 90, this means that the buyer of the contract can buy the underlying asset at 100 based on the contract, but in the market today the price is 80 or 90. So of course the other party won't exercise the contract. The other party won't use this contract to buy the stock at 100 while in the market the price is 80 or 90. So the other party won't exercise. This means the seller of the contract can take the profit, can take the premium, and this is his profit. So the seller's profit is the maximum can be the premium, the $5 that he or she collected in the beginning to sell the contract, to issue the contract. And you can see the loss for the seller can be unlimited because the underlying asset price may increase every day, and the loss will grow. And what is the break-even point? The break-even point is 100 plus 5, $105. Now, another example. Suppose today, suppose after 2 months, now the stock price in the market is 120. What happens? Short call. Call means the buyer has right to buy the underlying asset at $100, while in the market the price of the asset is 120. So of course the buyer of the contract will exercise it. Means the buyer will exercise the contract. So now the person who is short call has to sell this asset, this stock to the buyer at $100, while in the market this is 120. So $20 loss minus $5 premium that the short call person, the seller, has collected in the beginning. So this means $15 loss. What about long put? So for long put means you have, the person who is long put means the person has right to sell the underlying asset at the strike price. In this example, option price means premium is $7, exercise price is $70. This means, suppose you long put. This means that you have the right to buy. You have the right to sell the underlying asset at $70. So later, suppose the stock price, the underlying asset price, drop to $50. So you still has right to sell it at 70, but in the market the price is 50. So it's a good contract, right? You still can sell it at 70. So you exercise the contract. It means you sell it at 70, but in the market is 50. So you make $20 profit minus the premium, the money you pay to buy this contract. Minus $7 means $13. So it's $13 here. But if the price goes above 70, like let's say in the market now the price is 100, will you sell the stock, the underlying asset, when the Apple stock in the market is 100? Will you use this contract to sell it at 70? No. Why should I sell it cheaper? So I won't exercise the contract. I'm long, I buy the contract, so I have the right to exercise the contract. So I won't exercise. My loss is limited to the premium that I paid in the beginning to buy this contract. So my loss is limited to $7. What is the break-even point? You can compute yourself, but the formula, if you want to quickly compute, is strike price minus option price minus premium. 70 minus 7 is $63. Now, if you are bearish, you believe the market will go down, you may sell stocks or you may long put. Both are used in this case. But for short stock, your loss is unlimited. If you short stock, you sell stock, your loss can be unlimited because the price of the stock can go up, 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 but you expected the price goes down. So there's no limit on your loss. But if you long put instead of short stock, your loss is limited to the premium you paid, 7 ringgit per share. And for short put is the other side, so it's from the seller's perspective. So the break-even point is 70 minus 7, and your profit as the seller will be limited to the premium that you receive. And this is your loss if the price goes down. Of course, the buyer of the contract will exercise it, and then this is a loss for you. Okay. Let me see what's going on here. Hey guys, how are you? Everything is fine? Are you following? Had you heard about options before? Of course, you have seen options in previous topics, previous subjects before. So, are you okay? Are you following, guys? Please write something in chat box. In the meantime, I will enjoy my coffee. Oh, interesting. Because I'm using. Oh, I'm happy to hear it. I'm not sure whether you are listening or not, but okay, as long as you say okay, this means That is good. Okay, let's continue. There are just three terms I want to share with you: in the money, at the money, out the money. So if the if exercising the contract now means profit, this is called in the money. If exercise price equals spot price of the underlying asset, this is called at the money. And if the exercising the contract means loss, this means out the money. So it depends whether it's call or put. For call, of course, you expect the price increases to be higher than exercise price. So you have in the money for call when spot price is greater than the exercise price. And for put, it's the opposite and so on. Okay, it's not really complicated, it's very simple. Now, one more thing. Option price. Option price, the option premium, has two components: intrinsic value and time value. Intrinsic value is the difference between the stock. Here we have the. So it's the difference between the spot price and exercise price. Or again, guys, another name for exercise price is strike price. So for intrinsic value means the difference between exercise price and spot price. So if it's a call, intrinsic value is spot minus exercise, because you expect the spot to be higher than the exercise price. If it's a put, you compute it by exercise minus spot, because for put you expect the spot price goes below the exercise price, right? So intrinsic value plus, oh, okay, one more thing. And these intrinsic values cannot be negative. So if they are negative, you consider them as zero. So if, for example, you buy a call and the price of the underlying asset goes below the exercise price, in this case, it's the intrinsic value will be negative when you compute, but then we consider it as zero. And the second component is time value. What is time value? Time value means it addresses how long we have till maturity. Why? Because more time till maturity means more expensive options. Why? Because your profit comes from the gap between the exercise price and strike price. Sorry, exercise price and spot price. So means the underlying asset price and the exercise price. If there is a difference between them, you will have profit, right? So when you have longer time till maturity, it means you have more time to capture a gap between these two prices. So these options will be more expensive. And at the maturity, the time value will be zero, because it's done, it's the last day. And what is reflected in the premium is just the intrinsic value. So then so at the maturity, option price is intrinsic value. So yeah, these are the two components. And so for example, if the price is 25 cents, maybe in this example, we computed. So the example is like this. So suppose the price is 25 cents, then you compute the intrinsic value and you see it's 15 cents. This means the time value is 10 cents. Okay, now strategies. So it was just an introduction on options. Now I want to share some strategies with you. There are four strategies that I want to share with you. Number one is naked positions or uncovered positions, then hedge positions, then spread, then combination strategies. For naked positions, it's like long call, short call, long put, short put, or long stock and short stock. These are just you don't offset your position. This means you don't combine them, right? It's just taking a position on the underlying asset or on the option contract. And we discussed this in the beginning of the class, right? So we won't repeat this. Just go back to these diagrams that we discussed. These actually are all naked strategies. I mentioned all these 6 strategies. Now, the second group of strategies are hedge positions. For hedge positions, oh yeah, let me just here, let's have a recap. So when you are bullish, you believe the price will go up, you may long call. When you believe the price will go down, you short call, right? And of course, when you believe the price will go up, you can long stock, and you believe the price will go down, you short stock. But oh sorry, I made a mistake here. So when you believe the price will go up, you long call or you long stock. Yes, but the difference is for long call, your risk is limited to the premium. When you believe the price of the stock will go down, you may long put or you may short stock. But if you want to limit your loss, you can long put. What about short call and short put? For short call and short put, we discuss here. For short call, this means, you see, your profit is here limited to $5, the premium. This means when you get this $5 premium, when the price doesn't move or when the price goes down. In other words, when you believe the price won't go up, when you believe the price won't go up, you will short call. And when you believe the price won't go down, you put. I don't say the price will go up, because even if the price doesn't move, still the seller will make profit. Because if the price doesn't move, there's no point to exercise the contract, and you can collect the premium. Now, for hedging, let me show you what I mean by hedging. For options, if you really want to quickly understand, you should have a look at the diagrams. There are so many strategies. Later I will share some of them with you. I'm sharing now with you some of them. There are so many that we won't even discuss in this class, but how to understand them, just look at the diagram. Here, this is hedging a long stock position. This means you already buy stock. Now your concern is, maybe in the next month, next 3 months, next 2 months, I'm just worried that what happens if maybe there will be some fluctuations in the market, or maybe in the next 2-3 months the value will drop, and I'm worried because I bought stocks, and I'm worried that in the next 2-3 months the stock price drops. In this case, you can use hedging. It's called portfolio insurance. How? You already are long stock, means you already bought stock. Now your concern is in the next 3 months the price of the stock drops. So you can hedge. How? You just long put. So on the same underlying asset, let's say it's Apple stock, you already bought Apple stock, and you're worried the price will go down in the next 3 months. So at the same time, you long put. So when you long put, this means that this contract allows you to sell the underlying asset at the strike price. Means in the next 3 months, you still can sell the Apple stock at the strike price. So even if the price goes down, you still can sell it at the strike price. This means you hedge. And the diagram clearly shows this. You see, this is long stock, the red one. And if you long put, the blue one, this blue plus the red line will give you the black one. So this black one is the result, the outcome of taking these two positions. So if you think about it, you see in this part, these two are moving against each other. So it will give you a straight line like this, a line which is flat at $5 loss. Why is this like? This is the cost of buying this insurance. This is the cost of taking this strategy. This means your loss now is limited to $5. Even if the price of the Apple stock dropped to $70, still you won't be affected, and your loss is just $5, right? And if the price goes up, okay, very good, I still make money. So you see, we combine different strategies. These 6 that I shared with you, we combine them, and we will develop very complicated and interesting strategies. So this is one of the simple ones. You already bought stock, you long put, and you will get the black one. And what's the black one? You can see the black one. It means your loss will be limited to the premium, even if the price drops. Hedging short stock means you already sold stock. You are short on stock, like you already have the red line. Now your concern is maybe in the next 3 months the price goes up. When you short stock, it means you believe the price will go down. You are bearish, right? But now your concern is, oh, I heard something, or maybe I guess the price may go up in the next 2-3 months. Then what you do? You just long call. Now long call means you have the right to buy the stock, because for short stock you need to buy. Short means you borrow stocks, sell in the market, later you have to buy back from the market when the price drops and sell to the person who you borrowed from. So in this case, long call means in the next 3 months you have the right to buy the underlying asset at the strike price. So the problem solved. You have a contract that allows you to buy it at the strike price. So even if the price goes up, you still can buy it at the strike price and fulfill your short stock position. So you see what happened? The red one plus the blue one will give you the black curve. Think about it. You will notice that it's the black curve. And the black one clearly shows that if the price goes down, you still have profit, and your profit is just a bit less than when you are just short stock. You remember in the beginning you were bearish, so you short stock, but now you are worried that if the price goes up, I will have a loss. The cost is $7, the premium you pay to buy, you buy call. So later, if the price goes down, it's a good news for you because you're short stock. So you still have your profit minus the money that you just paid to buy call, right? And why you paid to buy this call? The only reason is because if you were wrong and the price instead of reducing increased, your loss is limited to the $7 premium. Yep. What is conversion strategy? Conversion means I don't want to be affected. Means you see the outcome is this flat. This is the flat line. This means even if the price goes up, even if the price goes down, I don't want to be affected. You may say, oh, so why I may implement this? First of all, as I said, sometimes you want to lock in the value of your portfolio. You want to lock in the value, the price. So you see the price won't change, right? But you may say, for example, here, let's go back here. Yeah, suppose you would say, oh, what if I buy stock? You see, you already buy stock. You are long on stock. This is the assumption for conversion strategy is you buy stock. I have Apple stock. Now I'm worried that the price of Apple stock may drop in the next 3 months. We already had this, right? You remember? Here. You already bought Apple stock. Now you are worried what happens if the price of Apple stock drops in the next 3 months. You use portfolio insurance, right? It means you long put. The advantage is then you will get the black curve. I just explained this, right? So the good thing about this is if the price drops, your loss is limited to $5. But if the price goes up, you will have strong profit. But here, it's the same scenario. You mean you long stock, you already have Apple stock. Now your concern is what happens if there are some fluctuations in the market. So why instead of buying a call to still benefit from profit if the price increased, why I may long, you see, it's long put. I still long put, but I also short call on Apple. You know, do you get what I mean? I mean, in the previous one, which was portfolio insurance, I already bought stock. Now I want to use portfolio insurance. I long put. That's all. The advantage is my loss is limited to the premium. But if the price increase, I still make money. But here, your long put. This means portfolio insurance. Long stock plus long put means in portfolio insurance. But then I short call. And when I short call on top of that, this means that I will get a flat curve. This means if the price goes up, I won't benefit. And this means I always, you see, it's the same line, which is the premium I pay. It's the difference between these two premiums. Why I may do this? I could just long put and that's all. My risk is limited to the premium, and also if there is any profit, I will earn. But here, I won't have the chance to have any profit if the price increases. So why we may short call on top of the portfolio insurance? Because this plus this is portfolio insurance. Why am I short call? Think about it, and if you couldn't, not well, you should answer this. But okay, think about it and later remind me during the tutorial class to discuss this. But this is interesting, right? Let me see, maybe some of you answered the question. Okay, let's continue. Now, the third group of strategies, spread strategies. To profit from expected marginal price movements while protecting downside risk. This is for speculators. Some speculators use these spread strategies and there are two types of spreads, bull spreads and bear spreads. So yeah. So what we mean by spread? For spreads, I don't see it here. Okay, yeah, he's here. Okay, we implement these strategies by combining only calls or only puts. Means we don't mix call and put. So it's strategy speculators may use by combining calls or puts, not a call and put, right? I will give you some examples. Okay, first, when will we use each strategy? For bull spread, when one is neutral to bullish or moderately bullish, about that means, yeah, okay, as I said, it's always easier to have a look at the diagram. So you can see here, this is for a bull call spread. This means that, as you can see, your loss is limited, your profit also is limited, and in between you may have some, it's a line that connects these two lines, so you may have some profit. So this is the bull call spread. This is a bull put spread. So again, you will have some profit, you may have loss which is limited. Here it's a limited loss, and in between we connect these two lines. So do you see any similarity between bull put spread and bull call spread? So this is the black one here. The black one here is bull call spread, and here the blue one is bull put spread. The similarity is both of them are actually almost the same. So when can you make money? When the price, underlying asset price increases. When the underlying asset price increases, you may use these strategies, right? When you believe the price may go up. If you were wrong, then your loss is limited, as you can see here. and how to make this curve. Actually, the idea is we just want to have a curve. Now, how to make this curve, how to make this bull put spread or bull call spread. For bull call, we mix two calls, and for bull put spread, we mix two puts. So a bull spread is used. So you see, there's no call or put here, right? It's a bull spread. It's used when someone is neutral to bullish or moderately bullish about the underlying asset price. Now, how to implement bull spread? You may use call or you may use put. Then a bear spread is used when someone is neutral to bearish or mildly bearish. How to implement? You may use call or you may use put, right? So bull spread has two types here. You see, bull spread has two types. You can make it using calls, or you can make it using two puts. So you long call, short call. Here you long put, short put. And then for bear spread, you can make it again using two calls, or you can make it using two puts. Now let's see how to make it. Let me give you first an example to understand what we mean by call spread. So a bull spread. Suppose that you are moderately bullish about the performance of a company over the next month. You want to use options to benefit from expected moderate stock price appreciation while minimizing your downside risk. So you see, the case is very clear. There is a stock and you are moderately bullish. So you want to use options to benefit from the expected moderate stock price appreciation. So it means if you believe it may go up a bit, moderate stock appreciation, but at the same time, so based on your analysis, you predict that moderately the price may increase, but you don't want to take much risk. You want to limit your risk, you limit your loss when you are investing, when you are trading. So now here you can use bull spread. Now how to implement bull spread? You may use two calls or you may use two puts. Here in this example, you can see how we use two calls. When you have two calls, here for example, there are two calls available in the market. They are both on the same underlying asset, of course, GT Berhad. 9.5 ringgit call at 15 cent. This is one call, and the other call is listed at 10.5 ringgit call at 0. What does it mean? This means that the strike price or exercise price of the first call is 9.5 ringgit. The exercise price or strike price of the second call is 10.5 ringgit. And the premium means the price of the first call is 15 cents, the price of the second call is 5 cents. Now, the bull call spread would require purchase of the call with the lower exercise price and sale of the call with the higher exercise price. So you buy the lower exercise price and you short the higher exercise price. Means here for long you pay 15 cents to buy this call, and then you sell this call at 5 cents and done. How can I know that I could get this diagram? Now, how to show your payoff? How to compute your profit and loss? You construct this table. So again, to summarize, there is a stock, and your expectation is the price moderately may increase, and you don't want to take risk. You want to limit your risk, your loss. So what you may do is you may use a bull call spread. How to implement bull call spread? You need to use two calls and at different prices. So you long the cheaper call and you short the other call, and this is called a bull call spread. Now, I construct a table to show that it works. stock price has been listed here. So it is up to you. For example, here I have listed 8 ringgit 90. So the underlying asset price, has been listed for different prices. I want to test, right? I want to see what is the outcome. So let's say 8, 9, 9.5, 9.6, 10. So up to you. I just want to see at different prices what will be my profit or loss. At different prices of the underlying asset, what will be the outcome of this combination. The second column shows my profit and loss from long, the first call, long 9.5 ringgit call at 15 cent, the first one. The second column shows my profit and loss for this one, means the selling 10.50 call at 5 cents. So as I said, 5 cents is the premium and 10.5 is the strike price. Now, if the market price of the underlying asset is $8, what will be my profit and loss for the first one? Long call. Long call means I have the right to buy the underlying asset at 9.5. But today the market price is 8. So the market price is 8 ringgit, but based on this contract, I have the right to buy the asset at 9.5. Why should I use this contract? When the market price is 8, why should I buy it at 9.5? So I won't exercise the contract. This means the seller of the contract will take the premium. This means I will lose my premium. So my loss is the premium. I won't exercise the contract because I am the buyer of the contract. I have right to not exercise the contract. So my loss will be 15 cents. It's the same for 9 ringgit 9.5. I won't exercise the contract because I'm long, means I have right to buy at 9.5. So what's the point to buy it at 9.5 based on the contract when the market price is 9? Then suppose the price increases and goes up to 11 ringgit or 10.5 ringgit, let's say 10.5. If the market price is 10.5, based on the contract, I can buy it at 9.5 and it's good. So I can make 1 ringgit profit, but I already paid 15 cents to buy this contract. It's the premium I paid. I'm buying the contract, I'm long. So 15 cents is the cost that I paid to buy this contract. This means my net profit is 85 cents. So I compute profit and loss for this contract at different stock prices at the maturity. And I do the same for the second one, short 10.5 call. So this means that today the market price, sorry, the underlying asset price is 8 ringgit, and short call means I'm selling call. Selling call means there is another party who is buying the call, and buying the call means the other person believes the price will go up, but actually the price went down. The price is $8, but the exercise price is 10.5. So the other party won't exercise the contract. As the seller, I will collect the premium. This is my profit. So my profit will be 5 cents, and the maximum profit for the seller is 5 cents. You remember I'm not teaching you anything new, guys. This is the same thing. You see, my profit is the premium I will receive for short call, right? So I will meet for all of these strategies. We will use those 4 simple strategies. So it's the same thing for 9 ringgit 9.5. I still, as a seller, will take the profit. But if the price increases to 11.5, the other party, when I'm short call, the other party who buy call will exercise the contract. Then I will have $1 loss, but I already received 5 cent premium. This means my net loss is 95 cents. Then for each of these prices, you just add the first 2 columns, the column number, the profit and loss from these 2 instruments, and you get the value of combined position. So 15 cent loss, 5 cent profit from the second contract means in total 10 cent loss. 15 cent loss from the first contract, 5 cent profit means 10 10% loss in total, and you compute all, and you get the break-even point at 9.6. So when you draw this, you will get exactly this black curve. So you long call, you short call, you see, you long call, short call, and the combination of these two blue will be the black curve, which is the outcome. And what's the break-even point? Lower exercise price plus the difference in premium. So lower exercise price means 9.5 plus the difference between these two means 10 cents. So it's 9.6. 9.6 is the break-even point. So it's my profit and loss diagram. So, yep, I'm just showing you different examples, right? So this is a bull call spread. You may use bull put spread. So this means that you use two puts. Two puts. So you may make the same diagram, the same combination using only puts. So how? Here, as you can see, you long put, you short put at different prices. You long the cheaper, here you long the cheaper one and short the more expensive one, and you get again the same combination. You gain the same diagram, right? It's the same one. So how to construct? Again, you construct the table. These are the stock prices at this shows different stock prices. We want to see for each stock price what will be the profit and loss from this strategy. So because we long a contract, so again 9.5 is the strike price or exercise price, 10 cents is the premium, and this means you buy this contract at 10 cents. Short $10 is the exercise. It means the underlying asset price. You can the underlying asset price. Yeah, it's the exercise price for the underlying asset, and the price of this contract is 58 cents. Means you can sell this contract at 58 cents. And then the first column shows the first contract profit and loss for the first one. The second one, the next column shows the profit and loss for the second contract. Now let's test one of them. Let's say the underlying asset price is 8 ringgit. So when you are long, this means, and the exercise price is 9.5, means your long put. Long put means you have the right to sell. You have the right to sell the underlying asset at exercise price at 9.5. But in the market, the underlying asset is 8. So you can sell it at 9.5, but in the market it is 8. So it's good. This means you make $1.5, the difference between these two, $1.5 profit minus the premium you pay to buy this contract, because you are long, you are buying, right? The contract. You're buying the contract, right? So it means $1.40 net profit. Another one, let's say if it's $10. So based on this contract, you can sell the stock at 9.5, but in the market is 10. Why should I sell it at 9.5? I won't exercise the contract, and my loss is limited to the premium I paid, 10 cent premium. What about the second contract? The second contract, let's say if the price, underlying asset price, is $8 in the market, so you are selling, you see, short put, you are selling put, means there is another party who is buying this put, and this means the other party expects the price goes down, and actually here the price went down, so it's good for the other party, for the buyer of the put, and it's bad for me. So now the other party will exercise the contract. The buyer has the right to exercise. So buyer will exercise the contract, and this means that the buyer can sell this contract to me at $10, but then the market price is $8. So $2 loss. But I, as the seller of the contract, I already received 58-cent premium. So $2 minus 58 cents is 1.42 is my net profit, net loss. And the first plus second column will give you the net profit and loss from the combination. And then when you plus, so you can see the break-even point is 9.52, and if the price is below 9.52, your loss is limited to just 2 cents. But if there is any, let's go to here. Yeah, if the price increase goes above 9.52, it's a profit for you, right? And you see here how we have mixed these two, and then we get the blue curves, and we already have seen this in the table, how we mixed these two and got the combination. So the lower one, 9.5, is the strike price here, then the strike price $10 here, and the break-even point here is the higher exercise price 10 minus the difference between these two, 10 minus 48 cents means 9.52. So it's a summary of what we discussed. When will we use them? So in the exam, I may give you a case and ask you to suggest what strategy to use, and you need to do all these calculations. And what's the break-even point? What's the minimum loss, maximum profit, whatever. And you can do the same for when it's a bear call spread. And for bear call spread, you use two again calls. You short one call, you long one call, short the cheaper one, and call the other one. Sorry, long the other call. The same thing. You construct the table, you do the calculation, you will get this. So the shape for the bear call spread will be something like this, right? This means your profit and loss are here. So you have limited your loss to 25 cents, and here it means you're moderately bearish. You're moderately bearish, right? This means that if the price goes down a bit, you have some profit. Okay. Now, and you can construct the same put spread, and bear put spread using only puts. So you just combine two puts, as you can see here, short the cheaper put, long the more expensive put, and then construct again the table, and you will get the same shape of the bear call spread. And yeah, it means, as you can see, this means you are moderately bearish, because if the price goes up, your loss is limited to 40 cents, which is the difference between these two premiums. And yeah, so on. So, and this is a summary of what you need for bear put spread, bear call or bear put spread. So this was spread. You see, you need to really go through today's topic, because there are so many terms I'm using. Actually, it's a bit, wait, hold on. Yeah, okay. Yeah, you need to practice, and I mentioned many times put, call, long, short, and we combine all these. So any question, anything so far? Are you comfortable with the topic? Is the topic okay? Oh yes, I need to bring some water. So write in the chat box whether you're comfortable with this topic, and whether compare with previous topics, whether it's easier or not, and whether you are following. So give me 1 second, I will be here. Okay, this topic is, to me, is very. If you ask me, this is the most interesting topic in finance options. Honestly, I'm telling you the truth. But as Ethan mentioned, you need to practice. Okay, and the last one. The last group of strategies. Sorry, yeah. Combination strategies. So for the previous one, spread strategies, we combine two calls or two. We only use calls or we only use puts, right? But here we combine call and put. So when you combine call and put, you can name it combination strategies. And two of the most common methods, strategies, are called straddle and strangle. I'm reading here, straddle and strangle. So I think I will just explain these two to you. There are so many other strategies you can find on the internet, and every semester I give students some strategies that they never have heard about them. The reason is because if you understand the logic behind them, you can use any string and interpret. You can um implement any strategy that you want. So let's start with straddle strategy. Straddle strategy has two types, long straddle and short straddle. The long straddle involves the purchase of a call and a put option on the same underlying asset at the same exercise price of the same maturity. So I think the best idea is to show you what will be the outcome. Yeah, this will be the outcome for long straddle. You see the blue one. So what does it show? The long straddle, as you can see, the outcome is this, the blue one, right? All of them are blue, but this one, the line, not the dashed one. So this is a long straddle. So as you can see, you will have loss when you are in this area, right? It's between 6.8 to 7.2 in this example, you have a loss. If the price is less than 6.8 or is more than 7.2, you have a profit, right? What does it mean? This means you use this strategy when you believe the price will change, may go up or may go down. So this means you believe the price won't be the same, let's say in the next month or next 2 months, right? Because if the price will remain the same, you will have a loss, which is the maximum loss. And this is short straddle. For short straddle, what do you see? This curve. This means the maximum profit happens here, right? So if the price doesn't move at all in the next 3 months, if the price remains at 8 ringgit, you will have the maximum profit. But if the price goes up or down, your profit will reduce, and if it goes above 8.4 or below 7.6, you will have a loss. So when will you use this? When you believe the company will be the price of the stock, underlying asset price, I mean, will remain the same. It means no changes in the next 3 months. A company which is very stable, right? So now, what is the difference between straddle and strangle? For straddle, you see it's a very narrow area. It's between these two, right? But for strangle, there is a range. For example, this is long strangle. For long straddle, it was a narrow area, but for long strangle, you believe there is a range. Means you believe the price will go up or down and will break out a range. And when you use short strangle, for short straddle that I just showed you, it will be like a peak, right? It will have a sharp peak. This means for short straddle, for short straddle, as I said, short. You see, let's go back there. Short straddle. You see, it's very narrow, right? Here the area is narrow. But for strangle, you consider a range, means your profit happens here, the maximum profit. For example, when you believe that the price will change in the next month or next 3 months in a range. So if the price breaks out the range, goes up or below the range, then you will have a loss. So this is the concept behind of straddle and strangle. Now, how to implement long straddle? Okay, the example is a company, it's the largest oil refiner, has just been subject to a takeover by Saeed. You notice that this is a potential fluctuation situation. Okay, so um, so in this case, you believe the okay. There are two options. Number one, if the takeover happens or not happens, then in this case you may say the price, the stock price, the underlying asset price, we may go up or may go down. So there is an offer, right? So the company must decide. I mean, maybe the company, the takeover will happen or not happen. There's no other option. The takeover will happen or won't happen, right? So in this case, the price will increase or may increase or may reduce. So if the price doesn't change, you will have a loss. So in this case, I believe the price will go up or will go down. It depends whether the takeover happen or not happen. So in this case, you may use long straddle, right? So suppose that, yeah, so you believe there will be fluctuations. You believe that it's volatile, right? It means the price will go up or down. So you believe in the next month or next 3 months here, the price will go up or down. It won't be the same. So you may long straddle. So how to long straddle? The same strike price, $7 in this example, you long call, you long put. So you see, I'm using call and put. For a spread, it was only call or put. But here, long call, long put at the same exercise price. Then you again construct the same table and then compute the profit and loss for different scenarios, different stock price, underlying asset prices, and you compute your net profit or loss. So it's the same thing again. And what you will get is this shape. So you can see here, this is the dashed one here is long, dashed line is long call, long put, and this one is long call. We already have, I showed you this in the beginning of today's lecture. If you combine these two, you will get this one. And this means you will have profit if the price changes, but you are not sure which way it will change, which direction it will go. So for both cases, you will make profit. If the price goes up or goes down, you have profit. But if the price doesn't move, you have a loss. And your loss is limited to the premiums, because if the price doesn't move, you won't exercise any of these two contracts. So you are losing the premiums, 12-cent premium, 8-cent premium. So it means your loss is 20 cents. Your maximum loss is 20 cents. So long straddle. When you use, when you believe underlying asset likely to undergo extreme volatility. And the risk is limited to the total premiums that you pay for those two longs and unlimited profit. Break-even point, the formula is given to you, call exercise plus total premium and put exercise minus total premium. You see here, this is the total premium is 20 cents, right? So $7 plus 20 cents, $7 minus 20 cents. These are the break-even points. Okay, the next one, short straddle. For short straddle, you short a call and short a put at the same exercise price. Then again, you construct the tables, you compute, and you will get this. You see, short call, short put, the dashed lines. And the combination is this short straddle. And what's the break-even point? So for short, you are selling. So you collect these two premiums. So in total, you are collecting 40 cents, these two. So your maximum profit happens when the other party for these call and put contract options won't exercise the contract, and then this happens when the price doesn't change at all. And the price doesn't change at all, so you collect it. Your profit is the total premiums you received, 40 cents. But if the price changes, yeah, your profit and loss will change. So this happens when you believe the price won't change at all, right? You believe the company is stable over the next 3 months. So when minimal price movements is expected, and your risk profile is limited upside, unlimited downside, you can see here. So your profit is limited, but your loss can be unlimited, right? And the break-even point is call exercise plus total premium. I already explained this to you. So it's $8 plus 40 cents, $8 minus 40 cents. These are the break-even points. Then we have strangle. I already explained to you. Strangle is very similar to straddle, but it has a range there, right? So how to exercise? Okay, let's first give you the example. A company is a large plantation firm whose stock has traditionally been trading. So the company over the past 5 years, let's say the stock price has changed between 6.5 to 7.5. So there's a range for price changes. Historical price changes is in this range. Now you believe that because some problems that company faced recently, then stock price will change. So the stock price, let's say you believe that the price will change and it will be out of the range that you expect. You believe that not you expect, out of the range of historical prices, right? So you believe the price will outbreak the range. So over the years, it has been moved between 7.5 to 6.5 to 7.5, and now you believe because of some issues, the price may go up or down. Maybe the government wants to give them a big loan, and you are not sure whether they will get a loan. If they don't get the loan, they may face serious problems, and their stock price will drop. If they get the loan, then they can maybe invest and improve or whatever, and the stock price will increase. And you are not sure whether they can get the loan or not. But if they don't get, the price drop. If they get, the price will improve. So, and you believe the changes is out of this range, then you may long strangle. How to long strangle? You see the difference? You long call and put at different prices, 6.5, 7.5, and then you will get this shape. So this shape is the outcome of long put and long call at different exercise prices. And here the break-even point is 7.5, the higher exercise price, plus the total premium. The total premium, you're buying two calls, you are paying 15 plus 20 cents to buy these contracts. And the other break-even point is 6.5 minus these two, minus 35 cents, means 6.15. And your maximum loss will be the two premiums that you have paid. If you are not able to exercise any of the contracts, means the price is in this range, then your loss is limited to 35 cents premium you paid. So for long strangle, you use when underlying asset price expected to break out of current trading range, and you have limited risk, unlimited profit, and call exercise. Okay, this one I already explained was the break-even point, and is to take advantage of extreme volatility cause a price breakout from a range. And the last one, short strangle. So again, very similar to short straddle, but it has a range. How to implement short call, short put at different exercise prices. You can do the same calculation and you will get this one. And this happens when you believe the price in the next 3 months will be moving in this range. So if it's moving in this range, you, as the seller of these two contracts, this means the other party won't be able to exercise. So you can keep the premiums, 35 cents. And your break-even point is 7.5 plus 35 cent total premium, or 6.5 minus 35 cent total premium will give you these two break-even points. Okay, when to use? When underlying asset expected to continue trading in its current range, means that in the next 3 months the price of a stock price won't go above or below the range, and the profit is only the profit has a maximum, but the loss can be unlimited, unfortunately. And break-even point I already explained, and so on. Okay, so I have explained so many strategies today. There are many other strategies as well, and this topic can be very interesting if you really spend some time on it. It can be the most interesting topic in finance that you have studied so far. But I understand that so many terms are used today. Make sure you study. When you are comfortable with them, go for other strategies. There are other strategies in the slides, like butterfly spread using calls, or there can be many types of butterfly. For example, here, when will you use this? When you believe the price will be at this level, and you want to limit your loss. Here you limit your. So what's the difference between this and this one? This short straddle. You see, it's this one. What's the difference between this and this one? The difference is in both of them you believe the price will be the same at this level in the next 3 months. But for the other one, for this one, you are limiting, for butterfly spread using calls, you limit your loss. So there are many other types. You can. This one actually is the next topic. Okay, till here. So there are many other types, and many that I have not provided the information here. So what I want you is practice practice the first 4 strategies that I shared with you. If you are very comfortable with the first strategies, the first 4 strategies, then you can understand, digest the other strategies as well, and you need to practice. So we will be working on more questions during the tutorial classes. I think I already provided too much information for today. If you have anything you want to share, please write in the chat box. In the meantime, I will share the attendance list with you for today's class. Okay. Okay. I share the link with you. Preview. If you allow me, I will insert the link in times. Futures and options. Okay. Okay, guys, I posted the attendance list on times. Please use the form. Where is it? Yep. Use the form, fill out the form, and what is and the videos I have prepared for financial futures. You need to watch them before the next class on Wednesday. You need to write your name and a comment in the sorry, in the comment box, comments under YouTube video. I just want to make sure that you have watched it, because I noticed in the previous class that many of you had not watched the videos. So watch all videos and write your name and 1 or 2 sentences explanation about the video I prepared in the comments of the YouTube videos. Okay, guys, any question, anything you want to share with me? Ladies and gentlemen, anything you want to share? Okay, if I didn't write my name, but I write my student, is it okay? What do you mean? How did you? Ah, yes, yes. For the YouTube videos, yes, it's okay. Just your name is okay, or your student ID is okay. But I prefer your names. But it's okay if you just write your student ID. Well, okay, Genchi, can you write your name as well? Later, add just one more. Just write your name. And below, yeah, below the videos in YouTube, please write your name as well. Yeah, student ID a bit difficult. So write your name in the. I just want to make sure you watch the videos. Any other thing? Okay, it seems everyone filled out the form. I close the form now. If you are done, I close the form. Okay, I close the form. The attendance list, I mean. Okay, guys, I will see you on Wednesday. And okay, no worries. Okay, I will see you on Wednesday. Take care and watch the videos I prepare. See you. Bye bye.